Alrighty, let's talk about business cash flow. So Brinsley just commented here, she mentioned that she runs a cleaning business and is having some challenges with cash flow. Most business owners can probably relate that they feel like they're working their butts off in order to grow and scale their business, but they never have much left over, particularly after they pay their GST, they pay their suppliers, they pay their team and all of their operating expenses, and then ultimately will have to pay tax on the profits. Now, we've got to realise that cash flow issues are a symptom for a deeper problem. At the surface, the cash flow issue that's presenting itself is largely due to kind of one of three things. The first thing is that you do not have the appropriate cash flow structure in place. So for that reason, you ultimately have no transparency or clarity over your cash flow, and that cash flow is getting consumed by the responsibilities and the complexity of your business. So for example, we've worked with many clients who believe that they've crushed it. They go look at their bank account at the end of the month and they go, shit, where's all my money gone? And they just feel out of control and overwhelmed and kind of deflated because they've worked hard, but the results don't line up with the efforts that they've put in. The second thing is that the business doesn't understand their cash conversion cycle. Now, this is probably less of a factor for a cleaning business, but can still be an issue, is that you look at your profit and loss statement, you see that you've made all of this money, however, that doesn't match your bank balance. And that largely is because of a lack of understanding of your balance sheet, particularly your cash conversion cycle, of how long it actually takes for you to be paid on your invoices that you send out. For many businesses, they've got tens of thousands, in some cases hundreds of thousands of dollars of invoices outstanding that they haven't collected. And that's either due to not having great payment terms, not following up, or having crappy clients. And the other part is accounts payable, right? The costs associated with you essentially obtaining your ability to do what you do, whether it be materials or whether it be subcontractors, being able to pay your bills on time, and the difference between when you get paid and when you have to pay will largely dictate the cash flow concerns. The third factor is understanding your financial model. And the big issue that I see with many businesses is that they haven't actually strategically set their prices. They have kind of guesstimated their pricing, or maybe they've had pricing that worked really well when they were a smaller business. And as they've grown and scaled their business, they haven't adjusted their profit or their pricing for the profits that are required based on the increased costs to run that business. Because what we've got to realize is that the bigger business that you have, often the more complexity that exists in that business, particularly when you run a service business where you're selling time for money. And we've got to realize that comes with operational complexity, and that obviously comes at a cost. So we see that for many business owners, they've set a particular price that when they were a sole trader or working on their own, as they've kind of continued to grow their business, they haven't necessarily priced in that growth, and therefore it's coming out of their pocket. So if you're experiencing cash flow issues, there's basically three things that you can do to solve these three problems. Number one, you need to set up a cash flow structure. Now, the idea here is we want to have a series of bank accounts that allow us to segment the various income and expenses that we get in our business. It typically involves having an income account that receives all income in, having a cost of sales account that pays for your materials and subcontractors, having an operating expense account or an OPEX account that pays for your salaried employees, your bills and utilities and other things that you run your business by. You then have a owner's pay account. So this is where you pay yourself, your number one employee. You have a tax account where you basically put aside money for super, PAYG and corporate tax if you have a corporation. Even if you're a sole trader, if you've got profits, you're going to have to pay it at your marginal tax rate. So we want to put that aside. And then lastly, we want to have a profit account. So we want to ensure that you have the ability to get two paychecks because you deserve it. You deserve to be paid for the work that you do working in your business, and you deserve to be paid for the risk that you take for owning shares in your business. So we set up this structure, and what we do is we set up a series of percentages to ensure that when money comes in, we divide it between all of these accounts. On average, when we implement this for our clients, they increase their profitability by about 15 to 20%. I'll give you an example. A client of mine that I caught up with yesterday, we've been working with him for 2 years. He runs a roofing business. We implemented this strategy 2 years ago, and he was in a really bad spot financially. And in 2 years, he's accumulated $700,000 in cash in cold hard profits as a result of implementing this and the other 2 steps, which I'll go into shortly. So, second step is understanding your cash conversion cycle. So, simple solution. Go into your balance sheet, if your accounting is up to date, and look at your accounts receivable, whatever it may be outstanding at the moment. Let's say, for example, it's $30,000. And I want you to divide that by the amount of revenue that you accrued in that particular month, and then divide it by 30. So what that will do is it'll give you your accounts receivable days. It's a rough formula, but this basically gives you some insight of how long it takes you on average to get paid on your invoices. You can do the exact same for your accounts payable days, but instead take your accounts payable and then divide that by your cost of sales in that month, and then divide it by 30, and that'll give you your accounts payable days. So let's say, for example, your accounts receivable days is 45, but your accounts payable days is 30. That means that you've got a cash conversion cycle that is impacting you negatively for 15 days. So you need to start remedying a situation for you to get paid faster. There's a really simple strategy that we implement for our clients that's called advanced and easy pricing. So we say, hey, if you pay on the day or pay up front, we will give you this price. And if you want to pay on account with payment terms of kind of 14 or 30 days, then you'll have to pay a 10% premium. Would you prefer the advanced or the easy option? The idea is here, guys, that you are offering interest-free finance to your clients and customers when you allow them to invoice on account. You deserve to be compensated for it. So that strategy allows you to do so. The third factor is pricing. I've actually got a pricing tool that you might want to use. It's called the Profit Accelerator Calculator. You jump into my bio and click on the Wealth Health Check link, and if you sign up there, you'll get access to the tools. And what the Profit Accelerator Calculator will allow you to work out is, based on the income that you want to achieve, what is the sensitivity of the various levers in your business, particularly what is the impact of putting up price. The interesting thing here is that if we put up our price anywhere between 8 and 12%, typically we have what we call an asymmetrical risk versus return. So the return you get as a result of increasing that, it outweighs the risks of the clients leaving or churning. So what that means is you're left with a net benefit. In the vast majority of instances, clients of mine who put up their price by 10%, let's say, experience no churn. The clients don't even care. The biggest limiting factor in that is themselves. So with these 3 things, appropriate cash flow structure, understanding your cash conversion cycle, and understanding the sensitivity of price in order to maximize your profit, it will ultimately put you in a position where tax is just a consequence of making money. You'll always have the money set aside. It'll never be an issue, and you'll accumulate fistfuls of cash very, very quickly. Hope this helps. Any questions, let me know.